Airports are often considered to be amongst the most defensive stocks to invest in due to their monopolistic qualities. Because of this fact, they're usually very expensive, typically trading at a P/E ratio greater than 25. During the global pandemic, airports have become much more affordable, and with the looming risk of extended travel restrictions, prices are now in value territory. Is this a golden opportunity to buy a cash cow on sale? Well, in this video, we analyse 4 publicly traded airport stocks to assess whether they can deliver long-term financial rewards. So let's review airport stocks on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. Now with that said, let's commence with today's video. Regular viewers of this channel will know that we usually start our stock analysis by reviewing the economic moat of a particular company. However, we can assume that all airport stocks have a clear economic moat for the following reasons. In terms of intangible or switching costs, airport stocks usually have a monopoly within a certain geographical area. It can take decades to obtain planning permission to build a new airport in a nearby location, and it is usually more viable to expand an existing airport than to build a new one. It's also difficult and costly for airlines to switch airports. From a cost perspective, airports generate 2 main sources of income. Regulated income, which includes landing fees, passenger processing, and aircraft parking charges, and unregulated income, which includes commercial revenues from retail, property, car parking, and other concessions. Regulated income is controlled by government entities who set constraints on how much an airport operator can charge for things like landing fees. Whilst this does place a limit on an airport operator, they are able to increase prices incrementally and often above the rate of inflation. As most airports are partially owned by governments, they're also able to borrow money at very low interest rates. From a scalability perspective, airports have relatively high capital expenditure as they continue to expand their operations. However, their maintenance costs are typically a fraction of this initial cost of investment. Prior to the global pandemic, global airline travel growth was expected to increase at an average of 5% per annum over the next decade. As the global middle class continues to grow over the coming decade, there will be greater demand for air travel services. Airport operators are constantly seeking to increase their non-regulated revenue. One of the best ways of achieving this is to enhance the customer experience within an airport by offering a comfortable environment, well-organized logistics, and a range of goods and services. Passenger experience is also of equal importance to the airlines, and indeed the whole aviation ecosystem benefits from a happy passenger. This is a great example of a strong economic network effect and demonstrates the unique moat that airports have. Now, each of the companies that we'll be analysing have these moat characteristics. So instead of completing a moat score for each area, we'll score the airports in terms of a general moat factor. The first airport that we will be reviewing is Auckland International Airport Limited. Auckland International Airport Limited operates Auckland Airport, which is the largest and busiest airport in New Zealand with over 21 million passengers per year. The airport serves as the main domestic hub for Air New Zealand and also the New Zealand hub for Jetstar Airways. It is one of only 2 commercial airports in the whole country, therefore giving it a clear competitive advantage. The main risk facing this airport is slow growth following the global pandemic and the reduction of tourism. So with this in mind, we score Auckland Airport a moat factor of 8 out of 10. Aeroports del Sureste is a Mexican airport operator listed on the New York Stock Exchange. The company operates 9 airports in Mexico, 6 airports in Colombia, and 1 in Puerto Rico. Approximately 2/3 of its passengers hail from international origins, and 1/3 of its traffic is domestic. Their airports have experienced significant growth over the past decade. Now, the main risk facing ASR are its concessions, which are due to expire in 2048. And with this in mind, we score ASR a moat factor of 5. Next, we'll be looking at Aéroports de Paris, or ADP. ADP operates 26 international airports. In France, it operates Paris-Charles de Gaulle, Le Bourget, and Paris-Orly airports. And it also owns 46% stake in TAV Airports, the Turkish airport operator. They are currently in the process of acquiring a 49% stake in the Indian group GMR Airports, which will include Delhi and Hyderabad international airports. Air traffic in India is forecasted to grow at an annual rate of 6.7%, so we can expect this stock to increase in price over time. And with this in mind, we score Aéroports de Paris a moat factor of 9 out of 10. Finally, we'll be looking at Flughafen Zurich, which is the Swiss-based operator of Zurich Airport. This company invests heavily in real estate and has an estimated gross rental yield of 9%, which is very good when compared to most commercial real estate yields. The company has 9 concessions globally across Switzerland, Brazil, Chile, and India. The main risks affecting this company are traffic growth rates at Zurich Airport, which have been relatively flat over the last 5 years. Another is regulation, as in 2019, the Federal Council lowered airport charges by 15%. We give Zurich a moat factor score of 7 out of 10. We will now complete a fundamental analysis and stock comparison jointly of the 4 airports. First, looking at Auckland Airport. Auckland's operating margin has been over 50% in 7 out of the past 10 years, which is outstanding. Their PE ratio is currently at 59. Later, we will look at how this compares with its peers. Interest cover for 2019 was at 8, but has reduced to 3 in 2020. This is a concern as it shows that the business may face liquidity issues if the lockdown period is extended. Auckland Airport have a dividend yield of 2.4%. Again, we'll assess how this compares with the industry average. In terms of their current ratio, the company have a current ratio of 0.19, and actually their current ratio has not been above 0.5 over the past 10 years. Now, again, this is a very low current ratio and indicates that the company has negative working capital. Their current ratio has increased to 1.81 in 2020, indicating again that the company is using its free cash flow in order to survive this challenging economic period. Next, looking at the free cash flow yield, the FCF yield currently stands at 1%, which is lower than previous years, but relatively good given the current trading conditions. Auckland's return on capital employed is below our 15% target, and their price to book ratio at 1.73 is fairly reasonable. For debt to equity, Auckland's debt to equity of 0.4 is below the required threshold that we have in place and is a good value, particularly when we consider the negative working capital. Finally, when we consider Auckland's share price over the past 12 months, they've experienced a 17% drop. So whilst this is a big drop, it's relatively small when compared to some of its peers. We'll now move on to ASR. ASR's operating margin has been over 50% in 6 out of the past 10 years, which again is excellent. Their PE ratio in 2019 was 16.8, but is currently at 11.5, which is at the low end for the sector. Interest cover for 2019 was 7, but this has increased to 12 in 2020, which is positive. Dividend yield is currently higher than Auckland's at 3.2%, and their current ratio was 3.1 in 2019 and is now at a healthy 3.9 in 2020, which is also very positive. Free cash flow yield was at 6.42% in 2019, but is negative in 2020, which we might expect due to the challenging trading conditions. ASR's return on capital employed has been above 10% in 6 out of the past 10 years, which is reasonable. Their price to book has been negative for the past 3 years, which is a concern as it indicates that ASR's liabilities exceed its assets. Further investigation is required here to understand what's driving this. Their debt to equity ratio, despite the negative price to book, has a very low value of 0.48, which is in line with Auckland and suggests that the airport industry generally tends to have low long-term debt. Finally, ASR's share price has dropped by 48% over the past year, which indicates that there is potential upside and capital appreciation for the stock. Next, we'll have a look at Aéroports de Paris. ADP's operating margin has been over 50% in 5 out of the past 10 years, which maintains the trend that we've seen with the other airports thus far. However, the other airports do have a better track record, and the 2019 operating margin for ADP falls short of both Auckland Airport and ASR. ADP's price to earnings ratio in 2019 was at 31, but this has since halved to 14.2, which again is reaching value territory. ADP's interest cover in 2019 was 2.3, which is the lowest in this group and a concern. So something that we would certainly want to investigate further should we consider purchasing this stock. Dividend yield for 2019 was modest at 2.6%, and the firm's current ratio for 2019 stood at 1.1, although its current ratio in 2020 has since increased to 1.6. Free cash flow yield was at 1.94 in 2019, which is less than ASR, but is now greater than ASR's at 0.2 in 2020. And ADP's ROCE has not gone above 10% in the past 5 years, which indicates modest growth potential for this company, something that we would take into consideration when developing our intrinsic value calculation. The price to book ratio for ADP at 6.7 is very high when compared to ASR and Auckland Airport, and this indicates that the stock has been expensive in the past, as this is based on 2019 figures. ADP's debt to equity for 2019 stood at 1.8, which so far is the highest in the sector, and judging that all the other airports are below 1, it's also an area that would be of concern to us. And then finally, moving on to ADP share price, it has dropped by 53%, so far the biggest drop in the sector. And again, this indicates that there is tremendous upside potential for this stock. Finally, we'll look at Zurich Airport. Zurich's operating margin has been over 30% in 3 out of the past 5 years, which again demonstrates the strong performance in operating margin for these airport companies. Their PE ratio is at 12 for 2020, which is in value territory, and interest cover for 2019 was at 22, which is by far the highest amongst the cohort of airport companies. Dividend yield for 2019 was modest at 3.94%, but is currently the highest in the sector as well. Current ratio was under 1 in 2019, which is good, However, this was the only time it managed to have a current ratio below 1 in the past 5 years. In previous years, its current ratio has been above 1, and this has crept up in 2020 to 1.6. So again, something we'd keep an eye on as we would for ADP. Free cash flow yield was negative in 2019, which is a concern. However, it had been consistently positive for 10 years prior to this. And this could be the direct result of investment costs, but we would need to look into this in more detail. Zurich's ROCE has been above 10% once in the past 5 years, which suggests modest growth potential, but slightly better than ADP. Their price to book ratio at 1.9 is reasonable and represents potential value when compared to the other airports on this list. In terms of debt to equity, Zurich's debt to equity has been consistently below 1 for the past 10 years, which is great. And finally, Zurich's share price has dropped by 32% over the past year, which means that there is fairly decent upside potential for this stock. When factoring the performance of each company against its peers, we have scored Auckland Airport a 5 out of 10, ASUR an 8 out of 10, ADP 6 out of 10, and Zurich Airport a 7 out of 10. The final step in our analysis is to determine the intrinsic value of the stock. At the investment store, we use a discounted cash flow method and Gordon growth model to estimate the value of an investment based on a company's future cash flows. Using an annual growth rate of 10%, we calculate an intrinsic share price value for Auckland Airport of 1.52 New Zealand dollars. Auckland's current share price at the time of recording is 7.29 New Zealand dollars. So for this price to be justified, Auckland would need to achieve a growth rate of 30%. Using Auckland's 5-year average growth rate of 35%, we calculate an intrinsic value for Auckland Airport of 10.83 New Zealand dollars. With this in mind, we give Auckland an intrinsic value score of 5 out of 10. Let's now move on to ASR. Using an annual growth rate of 10%, we calculate an intrinsic share price for the stock of 142 US dollars. ASR's current share price at the time of recording is 111 US dollars. And for this price to be a fair value, we would need to achieve a growth rate of 7% per annum. ASR was actually achieving a 5-year average growth rate of 15% prior to the pandemic. And if we use this value in our intrinsic value calculation, we obtain an intrinsic value of 210 US dollars. With this in mind, we give ASR an intrinsic value score of 9 out of 10. Moving on to ADP. Again, we'll start off with a 10% annual growth rate and get an intrinsic value of the stock of 74 euros. ADP's current share price at the time of recording is 84 euros. And for this price to be justified, ADP would need to achieve a growth rate of 12% per annum. ADP's actually achieved a 5-year average growth rate of 9% per annum. So using this number gives us an intrinsic value of 68 euros per share. And with this in mind, we score ADP an intrinsic value score of 3 out of 10. Finally, let's take a look at Zurich Airport. Using the 10% growth rate again, we calculate an intrinsic share price value of 72 Swiss francs. Zurich's current share price at the time of recording this video is 125 francs. And for this price to be of fair value, Zurich Airport would need to achieve a growth rate of 17% per annum. Zurich's actual growth rate is indeed 17% per annum. So this proves the accuracy of our calculations. this doesn't offer us a significant margin of safety. So with this in mind, we score Zurich Airport an intrinsic value score of 6 out of 10. In summary, we have recorded the following scores for Auckland Airport, ASUR, ADP and Zurich Airport. Out of all of these airports, we conclude that ASUR looks like the best value play at the moment. However, we would caveat this by saying that we would need to look deeply into the company's concessions and the likelihood of whether this will be extended beyond 2048. We'll be paying close attention to all 4 stocks and comparing them with other airports that are currently in value territory. Let us know in the comments below if you would like us to do a second video on these. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think of our findings. If you'd like to learn more about how we analyse assets, please subscribe to the channel. We look forward to seeing you on the next video.